I am Larry Tabb, founder of the Tabb Group. We provide research on financial markets infrastructure. We do a lot in fintech, and I'm here hosting a really great panel, really on the transformation of finance, technology's impact on Wall Street. So basically, are the guys on the end and over here going to disrupt everybody's business model? So, I've been a financial markets technology analyst for now 20 years, and I've seen tremendous amounts of change in the industry. It seems like every couple of years, the industry pivots pretty significantly from, trading systems to internet to web to mobile to now, what everybody's calling fintech, the whole revolution of trading bots. Just a lot of change in the last 20 years. That said, there's going to be a lot more change coming up in the future, and that's what this panel is about. We've got a great panel. To the far left, we have David Siegel, co-chairman of Two Sigma. To my immediate left, Dan Nadler, founder and CEO of Kensho. To my right, Adena Friedman, president and chief operating officer of Nasdaq. And on the far right, Corrie, Elston, chief technology officer of financial services of a small company that you probably never heard of called Google. And it's a really, really interesting time. There's a lot going on. With that, it's a lot harder to disrupt financial markets than it seems. It takes an awfully long time. To a certain extent, there's a lot of embedded regulation and infrastructure that needs to be changed. That said, I'm going to open it up first to Adena. If you look at technology as disruptive or transformational, do you see us moving in a mechanism where we're going to wind up adopting this new infrastructure, or do you see that we're all going to be unemployed by cell phones, mobile users?
No, I do think that one of the great things about the financial industry is that it has adapted to a lot of changes, whether it's change that's been generated by regulation or change that's been generated by clients. And I think that also there's an enormous amount of capital in the system right now that is inefficiently used. So there's a lot of friction in the system. So new technologies can come along, like the blockchain or machine intelligence and the cloud as well, to really help manage through those capital inefficiencies and the frictions and try to break them down. I think there's a high motivation throughout the entire financial industry to do that. And when you have motivated people, you have a financial incentive, and you have the technology that backs it up, I think you're going to see a lot of change.
Interesting. Dan, why don't you talk about, I'm sure not a whole lot of folks are familiar with Kensho. Why don't you tell them a little bit about what you guys do and what you're trying to accomplish and why people think of you as disruptive? You had a nice New York Times article a couple of weeks ago.
Yeah, certainly. So we were actually kind of vilified in the New York Times because a lot of what we do is focused around the automation of financial knowledge workers. We're the largest provider of analytics technology to Goldman Sachs, JP Morgan, Bank of America, Soros fund management firms like that. And the play is very much around taking very expensive human knowledge workers and trying to identify aspects of what they do that can be automated by machine intelligence. And so that's the play. And people view that in all sorts of ways. I think if you're one of the people getting automated, you don't like that. I think that others, and we're in a moment now where Bernie Sanders has a lot of attention, and this comes in waves. We obviously had Occupy Wall Street before that, but I think what unites the views of people like that and the young people for whom those messages resonate is the idea that the financial services industry extracts a heck of a lot of rent for the value that it provides, and a lot of that rent is not mispriced at the top; it's mispriced at the middle, right? So the Soroses and the Two Sigmas of the world add a lot of value, but you have probably the most expensive utility infielders in the world in this industry, making mid to low to mid six figures, moving columns of data around from one spreadsheet to another, and that's what's going to get automated in the next 5 years. That's the bet we're making, and that Goldman Sachs and JP Morgan and these banks are making. And my view is that the financial services industry on a 5 to 10 year time horizon is going to be one order of magnitude smaller in terms of headcount than it is today. and a lot more efficient.
I guess getting back to the original question, so do you think that, I guess you're looking at the transformational side. You don't see the players going away. You just see kind of the business, becoming more efficient and less.
They're just going to gain more operating leverage. Yeah, Goldman Sachs is going to be here in 10 years. JP Morgan's going to be here in 10 years. All the key players are going to remain. They're just going to be much more efficient organizations in terms of operating leverage, in terms of headcount. And that makes, if you look at that in the context of any other industry, that's not shocking. It's only shocking to the people who hold those jobs right now. But if you look at, I came across this very interesting article that was written about the airline industry and describing how inconceivable it was that people would ever automate ticket issuers, because they were describing, how many different variables in the decision tree there were. People might want to check additional bags. People might want to change their seats. People might want to upgrade their seats. How could that ever be automated? How could a computer ever do that? And of course, if any of us have ever been to an airport, we see that that's possible. Now, that's a very simple example. That's a very simple decision tree. But it's very notable and striking to me how, if you go back and look at the papers that were written as late as the late 1980s, people were describing how inconceivable it is that airline ticket people who they viewed as knowledge workers would ever be automated. Now they're completely automated. And I think you're going to see the next evolution of that in financial services, with the people in the low to medium, the analysts, the associates, the young VPs, the young managing directors. Anybody whose job is moving a column of data from one spreadsheet to another, those people are going to get automated.
David, you operate a pretty technology savvy hedge fund as well as a retail wholesaler. So technology is no surprise to you. So what do you think of this whole idea of disruption versus transformation, and how do you look at this fintech revolution?
Well, I think probably not differently from what you might observe in other industries. And disruption to one is evolution to another. If you think about Uber, which is, in a sense, some people would clearly argue it's a disruptive technology. I think I could argue it's very evolutionary. People are still, using in cars, getting transported around. They're just booking the cars differently. The relationship of the workers are different. I think that what you're seeing is in finance is something that is very similar. The methods of how business is being conducted clearly are changing, but in the end, the actual problems being solved are not really changing. There's a need to allocate capital efficiently. There's a need to match buyers to sellers. There's a need to register ownership of securities. Each of these problems, there's a need to look at data and to make decisions off of data. Let's just talk about that one, for example. In the old days, people would look at data with their eyes and their brain and make inferences from the data and make investment decisions off of that data. That was a model, and the kinds of people that did that were trained a certain way. These days, the industry is moving in a different direction, where the data is being examined by algorithms, and that the people that are involved with this more and more are not the traditionally trained investment managers, but they're maybe people with PhDs in math and physics and other disciplines that are applying more of the scientific method to the problem of making investment decisions. But I would argue that this is an evolutionary change. For the people that are completely disrupted out of the business, people with skills that are no longer applicable, they may feel differently about it.
Mm-hmm. So Corrie, you're at a fairly disruptive organization. How do you see this? Is it a transformation, evolution? Because to a certain extent, some of the things you're doing is going to, fairly significantly revolutionize not necessarily the business, but how people do the business and how people compute.
Mm-hmm. For me, I think it's to be determined. I think ultimately clients are going to decide what goes on. Their expectations at the moment are record-breakingly high, concrete, and immediate. Finance is in the process of transforming. If it doesn't transform fast enough, it will be disrupted by nature. I mean, you could think, I like the evolution analogy. Evolution can be fairly brutal at times, and I think of, one way of looking at this disruption is that it's an aggressive transformation. I think for me, one of the things that if I look back over history about how things have changed and transformed, I can't think of an example whereby ultimately looking through a lens backwards, that transformation or disruption hasn't been good. For anybody that's moving columns around from spreadsheet to spreadsheet, there's far better ways and more enjoyable ways to express yourself and build things.
So hard.
Well put.
Hand in hand with this, Adena, you run one of the largest markets in the world, as well as support a bunch of markets in the world. Post-crisis, and we're starting to see the banks change. We're starting to see firms like Two Sigma, Citadel, Virtu, other players kind of move in. I wouldn't say the big, white shoe firms are leaving, but the balance is mixing. How do you see, and it seems like the technology-enabled folks are growing. How do you see that playing out? And is this kind of a disruption on a longer tier scale that has really started kind of with, iNet and Island, which you guys bought, and some of the other,
Well, I think a couple things. First of all, Nasdaq itself has transformed from being a pure just exchange, U.S. equities exchange, to being multi-asset class and global, and we really see ourselves now as a financial technology company because of the fact the industry has changed so much. We provide the technology that powers 85 other markets around the world, and we also provide the surveillance technology to most of the street. So I think that it is a very different world today than it was 10 or 20 years ago, for sure. And when you look at what happened in the back of the credit crisis and how the banks have had to react, I think that Dodd-Frank and other regulations, Basel III, there are other things that have really gone into effect that have restricted their business. Certainly the Volcker Rule would be an example of that. Also, though, that they've had to invest an enormous amount of capital to reestablish themselves under this new regulatory regime. And they've had all of that time and attention, that money, the talent, has been really siphoned into that kind of reactive stance for the last 7 years. But what we are seeing now is the banks finally getting to the point where they can really start to look ahead again. And they have to live in a different world. Dodd-Frank really does limit some of what they can do, for instance, in terms of proprietary trading, using their balance sheet to own assets, things like that, are going to go to other players like a Citadel, a Two Sigma, and a host of other smaller firms that have come around. But what they then are now looking at is how can they still use and leverage their franchise to do more creative things around managing people's money, addressing retail, making sure that they are helping retail investors or institutional investors make smarter investment decisions, and things like that. So they're going to pivot, and we definitely are starting to see that pivot as they've been able to come out of this very reactive stance, and they're starting to really engage with the technology. And that's been a really big shift. I think that they really are absolutely engaging with the technology today, whether it's Kensho, whether it's with the blockchain, other machine intelligence companies. We actually just did a partnership with a machine intelligence company called Digital Reasoning around our surveillance technology to help bring e-coms compliance and surveillance together. And so they really are, I think, shifting their mindset and becoming a lot more creative and forward-thinking in the use of the technology that's around them today. So I personally think that they will survive, but they'll look different. I mean, they'll continue to shift, and there will be more players coming in to take some of the traditional proprietary trading and investing roles.
Dave, I'll bring that to you because you're one of these guys who are actually leading the charge at transforming some of this stuff. I guess I wouldn't say you're out there with a lance charging these guys, but you're building your own business which competes against them.
Well, I think looking forward 5, 10, 20 years is a hard thing to do when it comes to the impact that technology can have. My firm is now 15 years old, which I don't know if that's a long time or not, but it is pretty remarkable the evolution that I've seen in what we are capable of doing with algorithms and machines over a relatively short amount of time. So if you were to look more forward, you could imagine potentially some remarkably big, I would characterize not evolutionary, but revolutionary changes. I mean, imagine a world, in the not too distant future where imagine that you don't need banks to store money. Imagine if something like the Bitcoin technology, they just apparently today, a guy in Australia admitted to having invented the Bitcoin, although it's being disputed. But imagine a world with essentially money being, stored value being in Bitcoins. Well, that's taking away a major role of banks. You don't need banks anymore really to store money. It also has a big impact on government. One of the big roles of government, of course, is to issue money and to control money. And maybe regulators will try to block these changes, but I mean, that's pretty revolutionary change. Imagine, you mentioned the blockchain. The blockchain is essentially, for those not familiar, is a technology for distributed registration of anything, really. You can use it for a way to register electronic money. You can use it as a way to register titles and deeds or securities. It's a technology that does not rely on a central authority to provide registration information. Well, imagine if the world adopts that. Well, that's a big change too. Using advances in the blockchain with encryption, you can actually have a very private system where you can verify identity without, a central, for example, government backing it up. You wouldn't need your local town to prove that you own your house. Your deed would be stored, so to speak, in the cloud in a blockchain. These changes are actually pretty significant if they were to occur because, in fact, it's a remarkable power structure shift away from traditional banks, even away from government. I think this is actually very interesting to talk about today because it's wrapped up in the debate over encryption in the iPhone and privacy issues. Much of the change that could happen with technology that's already for real would completely change how financial transactions are made and who has access to the ownership of things as basic as money.
So when we talk, I'm going to continue on that line, David. When we continue with that idea that everything winds up getting registered on the net, we don't need, then all of a sudden, banks don't own the currency anymore, or the central banks don't have, influence on the currency. Can you? That would be very, very disruptive to banks, the governments, even municipalities. Can you actually see them relinquishing some of that power, or does the crowd take that over?
I'm watching the privacy debate and encryption very carefully right now because this will provide a bit of a clue as to how governments will be reacting to essentially loss of power. I mean, there's a power struggle going on right now. Are you entitled to absolute privacy with the data on your mobile phone, for example? And don't know what will happen. I actually believe it will ultimately prove to be very hard for governments to stop this advancement because the technology will be widely available and the government will essentially have to have some incredible police apparatus to track down all the use of the technology. I think it would probably be a bad idea for the governments to try to snuff it all out. Probably the same thing ultimately with virtual currency. I mean, how do you really stop it? I mean, it's just, software. It's running. It's not something that will be easy for the government to ban. And so I think it will take time though for these changes to occur because people will be pushing back as you see occurring right now with the FBI and the iPhone.
Adena, you're kind of in a heavily regulated area, not the fintech side, but certainly the exchange side. How do you see this being partnership with the regulators? Do you see the technology kind of taking things over? Or?
Well, I think I have a slightly different opinion. I do believe that the technology has the potential to make an enormous amount of change. So blockchain to us is a foundational technology that allows us to really rethink all of the post-trade activities in our space. But certainly I completely agree with you about real estate and other assets as well. I think, though, that in currency, it does ultimately come down to the ability to transfer ownership along with transferring money. And therefore, the ability to create a digital currency that allows for instantaneous transfer of cash or capital from one place to another, across borders potentially, is certainly in the sights of what we're trying to create. I think, however, I can look back on the equities markets, for instance, and I think that for the last 20 years, there's been a general view that equity should be a globally traded asset, that there should be the ability to maybe transfer the clearing books around the world and follow the sun and allow 24-hour trading of stocks, and you've heard of that. And the fact of the matter is that regulation is the reason why that really becomes very, very challenging. Regulators are nationalistic by nature. They're protective when it comes to making sure that their economies are protected. Currency is a foundational element of their economies, just like equities are. And so I do think that there's going to be more of a regulatory debate around this and while the technology will be there, just like the technology's been there for a long time to do 24-hour trading of equities, I think that it's going to be interesting to see whether you can break it down. Now, the one difference in this particular case with digital currency is that FX is already a globally traded 24/7 asset class. So, and there is no one single regulator that regulates the currency markets. But I still think that there's going to, there'll have to be some regulatory change that helps support this shift, and they will be nationalistic in looking at whether or not they should protect themselves.
Let's bring Corrie in here a second, then we'll get to Dan. Certainly the cloud and cloud infrastructure is going to be some of the technology infrastructure that basically enables this globalization and enables the transformation, enables the ability to get pretty inexpensive compute cycles pretty ubiquitously, no matter whether you're on an iPhone or whether you're on a computer or whatever. How do you see the cloud rolling out? Certainly, institutions were kind of leery against putting stuff in a public cloud. I think that's starting to break down now. But how do you see that playing out?
I think institutions are no longer leery per se. It's more a case of the practicalities of how we move forward. Security and privacy, those are sort of solved concerns. I think public cloud offers better security and the way to get better privacy. So I think it's more about the logistics of public cloud and how public cloud is properly positioned for the enterprise. Because finance is going to want hybrid clouds for a long, long time, probably forever. It's also going to want multi-cloud. So those are patterns which are particular to large organizations. I see the cloud being sort of several different things quadratically. It is true utility computing. So it gives finance a chance to get back to what finance really does best, which is innovative analysis and providing value to clients and not worrying about all of the other stuff. For a long time, I managed an electronic trading infrastructure. And a large part of that was painful. It was painful to get machines. It was painful to do networking. There really isn't any need for that going forward. So I see it being highly supportive. I think that it's going to be, on the other hand, revolutionary for financial institutions, but in the nicest possible way. It's the revolution that finance wants. And then the best example I can give to that is that if this wasn't the time for a revolution in finance, then the last 5 years worth of regulatory compliance wouldn't have been so utterly horrible within banks. From technology departments were doing great things and then basically all turned and did regulatory compliance. If an evolution of the strategies that finance has had for the last couple of decades was going to work, that wouldn't have been so universally horrible. So I think it's a revolution, and I think it's a wanted, needed revolution.
Interesting. Dan, you guys are, how do you see the cloud rolling out? Because to a certain extent, how do you see it impacting finance?
Well, I don't think it's theoretical anymore. So our whole rollout at Goldman Sachs firm-wide is built on top of the Google Cloud. We're a Google portfolio company. Our whole rollout at JP Morgan firm-wide is built on top of the Google Cloud, and everything we do in those extremely regulated entities is built on top of a cloud environment. So the comfort level's already there, and I would say it's not just a comfort level, it's an existential necessity. If you talk to Lloyd and Gary and these guys, they want to stop building technology infrastructure to a large extent. They especially want to stop building server farms and server banks and spending billions of dollars making 5-year plans to build something that within 5 years is completely obsolete. They view companies like Google as having solved that problem and having solved it in a better way than they could. The concerns were always about security, about data integrity, these sorts of things, which is why they needed last miles of connectivity between a public cloud, like what Google's built, and those entities, and that's kind of the role that we play. We're sort of the last mile of connectivity that allows them to run a secure query that's distributed across very large infrastructure and then reassemble it in a secure way. So, I think for a long time that was a very theoretical conversation. Would they be okay with it? And not only is it not theoretical anymore, they've been doing this for some time. I think that opens up completely new dimensions of computing, because most of the things that we do and most of the things that smart people want to do are incredibly computationally intensive, right? So there's the problem of, if you want to look for pricing inefficiencies across thousands and thousands of securities, across thousands and thousands of conditions interacting with those securities, and you don't really know what the pathways of impact are, well, that's an incredibly computationally, it's an open-ended, inductive, bottom-up, computationally intensive problem. Now, if you want to actually solve that problem, you need a lot of compute, but you probably don't need a lot of compute all day, every day. You need it for the hours or even a couple of minutes that you want to answer that question. So from an economic perspective, the elasticity of supply and demand is completely off in that case, in a non-cloud scenario, because you're going to go build $1 billion worth of computing infrastructure for the 5 minutes every maybe 3 days. You need that type of computing. You're not going to do that. That doesn't make sense. So what the cloud enables, and probably many of you in the room know this, is the elasticity of supply and demand with respect to compute. Now that that's been sort of solved and sorted and rolled out across these large banks, you're going to see what were relatively simple institutions previously start to ask and answer much more computationally intensive questions on a burst, highly elastic burst basis.
Well, that has a tremendous impact on staffing, on people, on budgets, on being an technology guy, on Wall Street. A lot of people are compensated based upon people and infrastructure and things like that. Does that cut at the quick at some of that stuff?
That's going to get decimated, literally. Mm-hmm. I mean, this is not just in the associates and VPs and junior MDs moving columns of data, but in the 10,000 so-called software engineers that Goldman Sachs has. The vast majority of them were and are maintaining completely outdated systems, legacy architectures. Were deployed to doing crazy things like trying to build a compute infrastructure when Google's done it better, and they just need to solve security. So those people are going to not have jobs. I'm trying to figure out a delicate way to say that, and there isn't.
That wasn't a very delicate way.
Those people are not going to have jobs, but what's going to happen is that financial services is going to become much more efficient. It's going to start to look like other industries. And I think why is that a good thing? Why am I passionate about that? The upside of that is it's going to have much better public relations with people in my generation, with millennials, who are really, the Bernie Sanders phenomena is, and his resonance with millennials is really a proxy for how frustrated people in my generation are that you have this industry that extracts a tremendous amount of rent on the economy. It does something very worthwhile, which is the allocation of capital. That enables drug discovery, that enables space exploration, enables all sorts of great things. But the rent that it extracts is disproportionate to the value that it creates because there are tremendous inefficiencies. And those inefficiencies arise with what are frankly really mediocre people feeling a sense of entitlement to six-figure jobs.
I think we're going to need a security guard to escort Dan out of here.
And so that's going to get, that's going to get automated. And I think that the impact on a 5-year horizon culturally is that people are going to feel less maybe ashamed to say that they work in financial services to people outside of financial services. And the discussions I've had with I've had discussions
all because people will love finance because we're going to move all our technology to the cloud. That will solve our image problem.
Mm. It will be a more efficient. It will be a more efficient, less rent extractive industry, and I think that's going to change the public perception of that industry.
Dave, let's talk about some of the I'd like to bring both Dan and Dave into this conversation about AI. So what you're doing actually with the infrastructure. When we looked at AI years ago, I was at Lehman back in the mid '80s. We were starting to look at AI, and David, you kind of build a business around this in terms of really trying to understand and theoretically use computing power to make decisions. How do you see that moving forward? Are we there yet? Is it done, or is it, where are we headed there?
Well, it's definitely not done. I think when you look at AI is clearly having a good run in a variety of fields these days. All of you are probably aware of the DeepMind's AlphaGo program, which it surprised people as to how good it was. And by the way, it keeps getting better. One of the remarkable things that we're finding in the field of AI is that the methods and techniques that we're using are proving to be surprisingly good to the actual practitioners in the field. That is a pleasant surprise to all of us. I know that the DeepMind's folks were unbelievably pleased with their results. In fact, maybe even a little bit surprised at how good they got and how quickly they got that good. I think one of the great challenges that society will have in the next generation for sure is adapting to the broad impact that AI and AI-like algorithms will have in disrupting a range of industries. I think that really the net effect of this is that us humans are going to have to really up our game. And I think it's already, by the way, happened where, very quietly, even if you take Uber, if you think about it, car dispatchers are, and even drivers' general intelligence have been replaced by algorithms. So, drivers no longer think about how to go from point A to B. They follow the map. And, the dispatching of the vehicles is done by algorithms. The whole thing is made more efficient because of AI. When you click on get an Uber to get here today, you were triggering many, many, many different AI algorithms that made your experience very pleasant and put a lot of people out of work. When you think about the investment world, it really is not going to be any different. And I think what we're going to find is that and this is very unfortunate, that us humans, our brains are only as good as they are. Evolution took us to the level that we are at today, which is a very impressive level. And there are many things that we can do that AI algorithms are incapable of doing yet. But on the other hand, it turns out that many skilled activities like investment management turn out to not require necessarily the most esoteric features of the human brain. Instead, they require the sorts of features that we're able to build into AI systems today. And these systems get better year after year, and we're not getting better year after year. I think this is a remarkably big change. For the job market broadly, I think this is creating a horrific problem. Solutions, I'm not positive of what they are, no one is, but I think it clearly points to the fact that humans have to up their game. They have to be better, more creative, more clever to compete with algorithms.
Now, Dan, you're kind of knee-deep in this.
Yeah, so I would second what David said. I think that actually the AlphaGo victory was far more an inflection point for financial services in terms of its implications than the chess victory. Because if you actually really understand this stuff and look closely at it, the Deep Blue victory over the chess grandmaster was a brute force optimization, right? The nature of chess is a very finite game with a finite number of outs, and so naturally a computer is going to get good at brute force optimizing the outs better than a human could. And the reason people in finance said, okay, well, we still feel safe, is because finance is not a brute force optimization problem. The second and the third and the fourth order effect, by the time you get even to the third order effect, the decision tree becomes nearly infinite. What was so transformative about what happened with AlphaGo was that it actually did not, because it could not solve the problem through brute force optimization. The nature of Go is actually a lot like finance. There's a second and a third and a fourth order effect and the decision tree just fans out to the point of near infinity. So how did they solve it? Well, what they did was they took a very different approach than what DeepMind did. They actually just studied really expert players playing Go, and the machine learned what those expert players did under every sort of different conceivable scenario that the expert player found themselves in. That's how Deep Go beat the best human player. The reason that's so transformative for financial knowledge workers is once you can do that, you're getting into the territory of being able to solve potentially open-ended second, third, and fourth order effects by studying the actual experts in the way that they interact with those effects. So like, capital markets and trading and finances, it's all about delta X, delta Y, delta Z. So the Chinese economy slows down. That has a knock-on impact on the cost of Australian rocks. That has a knock-on impact on Australian bank CDS. The problem is mapping out all those trees is very, very difficult. So how do you automate the knowledge workers who are doing that intuitively? What you do actually is you start training the machine to look at what, and the way they look at this is they look at the transactions, they look at the trades, they look at the flow, look at what those human experts are doing in any point in that decision tree. And then you see, actually, it turns out that the guys who make money when the Chinese growth starts wobbling actually express the delta X and the delta Y this way and not this other way. That's exactly how AlphaGo beat the Go player. So we're at a very transformative moment where what the human experts are doing is actually, whether the human expert is a Go player or a financial market participant trying to model out the second and third order effects of a Chinese growth slowdown, is actually now capable of being monitored, studied, analyzed, and critically replicated by machine learning technologies. So we're going to get to, and not just any one individual, but the entire population, such that the computer is smarter than even any individual expert. So we're going to get to the point where, and we're arguably already here, the computer can actually start to model the intrinsic structure of what financial market decision-making, investment management decision-making is all about, which is trying to figure out the decision tree of the second and third order effects much more effectively than a human can. And so we're pretty much at that point now. Over the next 5 years, is certainly going to play out and more fully and get solidified. And at that point, there's going to be very little that an individual investment decision maker can do that a computer is not going to already have learned from him.
Yeah,
How do you see that?
Yeah, one thing I would add to that, which I agree completely with, is that there's a flip side to why computers are doing so well in the investment world today and will continue to march forward, which is that because of globalization, because of the increased complexity of the financial world, if you 50 years ago, you could basically be a U.S. equity analyst, and you could create a U.S. equity portfolio without thinking about anything in the rest of the world. The interactions that you were describing didn't really exist, and you didn't. Today you can't think about a technology business in the U.S. without considering trends in China and what's going on in Australia. Everything has become so interconnected through globalization that the investing problem has become harder and harder and harder. It's not just more data. There's certainly way more data, but it's more interconnections. So what's happened is very bad for human investors. So the problem has actually become overwhelmingly hard because of the interconnections that have increased and the amount of data to be considered in making the decisions. At the same time, computers, their algorithms have gotten better and they are more clever, but maybe it turns out that they don't even have to be all that clever to be better than the overwhelmed human investment manager. So some people are basically arguing, well, I can meet with this expert human and they can really give me a great in-depth analysis of one segment, one little corner of the market, which is true. They can do a much better job than any computer algorithm can probably perform. But that little corner, that little segment that a human mind can handle and think about very carefully won't allow you to overall do a good job managing investments.
Because statistical arbitrage is no longer one type of strategy that David, Shaw, and you are doing. It's the entire global market now, right? We've gone, you're being very modest, but what happened was we went from a period where these markets were very verticalized and siloed, and then some clever people said, well, we can stat our, the ones that are interconnected, to a point now where there is no asset class that's not deeply correlated and coupled with every other asset class. And so the entire market analysis problem, investment management problem, is a stat arb problem. like stat arb is not a strategy anymore. It is the intrinsic structure of how markets operate. And so that intrinsically becomes a computational problem and requires a very different type of skill set for the people who analyze it.
Let's bring Adena in here because you're clearly on the front end of that. Certainly you have equity markets all over the world. You just bought eSpeed about a year or so ago. Are you starting to see demand from linking? Are your clients reacting more globally and trying to link your relationships across a lot of your clients?
Yeah, I think that's been going on for a while to make sure that they have connectivity to every market around the world, every clearinghouse. It's actually, frankly, a massive amount of infrastructure that clients have put together to make sure that they can, in fact, interconnect and manage all the data that's coming through as well. So from a human perspective, that alone has been a big undertaking, and one where the large banks, the large hedge funds, and certainly StatArb and other types of players, specialty players, are connected all over the world. That's actually one of the reasons, frankly, why Nasdaq's technology has propagated as much as it has around the world within the exchange community, because they want to have the same kind of connectivity, the same protocols, the same kind of rules, and the same way, and frankly, the same speed in the markets, whether you're in the Philippines, or you're in Singapore, or you're in Switzerland, or you're in the United States. They all use our technology, they all use our protocols, they all use our connectivity because of the fact that all of the world of investing and trading has become so interconnected. But with machine intelligence, we definitely agree, frankly, with a lot of what's being said here in terms of watching simple algorithms really change the nature of trading, and now much more complex algorithms and in fact, machine intelligence starting to change the world of investing. I think the challenge is going to be making sure that herd mentality does not become a stampede, honestly, when you have signals in the world that try to drive certain behavior and make automated trading decisions on the back of a machine-driven investment decision. If everyone's using the same data and everyone's making the same decision, if we see swings in the market today, the concern, of course, is to make sure that you don't see bigger swings tomorrow. So I think that having, I would say, machine intelligence layered on top of it with human judgment is probably the best way to go to make sure that we have kind of true intelligence in the marketplace worldwide.
And the robots don't get out of control. Corrie, you work for one of the, I would say, Google and knowledge kind of go hand in hand. How's Google kind of playing into this?
Google's been there for a long time. Larry Page said that Google's a machine intelligence company. Sundar has said over and over again how important machine intelligence is to us. And I think the key is that we've been building this history of expertise and thought leadership for 10 years or so. And I think the reason why everybody in this room should be super happy about machine intelligence is that at heart, machine intelligence is about data. And finance and all of you have loads and loads of data. It's a different way to look at that data. It's going to be hugely impactful because human beings, we've said it on the panel, human beings can effectively optimize about 4 to maybe 6 different dimensions. And it doesn't matter how intelligent we think we are, we can do about 4 to 6 different dimensions. And one of the reasons people thought that financial markets were we were unable to understand it is that the dimensionality of the data is so high. And along comes machine intelligence that can optimize across thousands and tens of thousands of different dimensions. Boom. There's a different way to do business. There's a different way to actually satisfy people in a much better way. And one quick comment, DeepMind is part of Google, so yay AlphaGo, it was fantastic.
Well, to a certain extent, I want to open up one more kind of strain of discussion before we open it up to questions. And I think one of the most threatening things out there for a financial institution is the blockchain, because this whole idea that all of a sudden I can trust Adena or Corrie or Dan or David without having a financial institution kind of be that hub probably scares the hell out of anybody who's in a trusted financial organization. Adena, what are your thoughts about, does blockchain completely get the bank, the financial institution out of the middle, and we wind up devolving into a peer-to-peer environment like tomorrow?
My answer is no, but I think that the technology has the potential, conceptually, to be quite disruptive, and not just transformational, but to be disruptive. I think that the fact of the matter is, though, there's still something called the extension of credit. There's still margining. There's still ways that people interact with the markets that is much more complex than just a buyer and a seller with cash in their bank accounts. So I think that the financial institutions facilitate a level of complexity in terms of the transfer of capital and the transfer of assets that we have to take into consideration. And I think they are also looking at this. I mean, the banks today look at it as both, I think, a huge opportunity and a potential threat. So they are looking at it, I think, much more holistically than that. I think that they see it as a way to completely narrow down the settlement times on the transfer of securities, which then frees up billions and billions of dollars of capital that's potentially trapped in the system. I think they see it as a way to make sure that they actually have a better understanding of the ownership trends and changes and shifts within their clients. I think they see it as potentially a better way to be able to extend credit more successfully, and they still stand in the middle of that relationship. And I see it, personally, we see it as a way to make the markets just remarkably more efficient and frictionless. And so I think right now the industry, the way that we've seen it, is more focused on the benefits. And I think that they'll obviously be looking at how do they mitigate the threat and continue to be a high-valued provider, not a low-value provider, but a high-valued provider to those end clients, so that they remain relevant to them in the long term. But so far, it's been quite a productive process of working with the established financial institutions, in addition to some disruptive players. Like Nasdaq actually has made an investment in Chain. Citi is a big part of that investment, as well as is Visa, Fiserv, and other players within the space. And we're having, I would say, extremely productive and constructive proofs of concepts around the blockchain that can be disruptive, but I think that everyone's embracing it as opposed to fearing it right now.
Corrie, what are your thoughts in terms of how blockchain gets rolled out, or is this disruptive, not disruptive, part of the infrastructure?
Blockchain has the potential to be hugely disruptive. And I think blockchain in finance, to me personally, shows both the best and the worst, or the less best side of finance. On the best side, finance has recognized something that has huge potential and is in there working with it and seeing what can be made of it. The less good side is that a lot of the emphasis at the moment is taking blockchain away from its strengths. A lot of the emphasis is on private blockchain, and I don't really understand what private blockchain is. Private blockchain is essentially just a database, and there's actually better databases to use for a lot of use cases. I think blockchain, you have to embrace what it actually is, and it's a way of doing business transactionally where there's a lack of trust. And then you look at private blockchain is sort of pulling it back and saying, no, we want to be in a trusted environment. Because if you think of rolling this forward, if you had a trusted environment 10 years ago, Lehman's would have been part of that trusted environment using private blockchain, and private blockchain wouldn't have solved a single problem. It actually would have magnified the problems. So I think it shows both the best and the worst.
Well, I somewhat disagree with that, because I think that a lot of Lehman's capital was held in these clearinghouses, and the transfer of ownership was still yet to come, and they were basically using the clearinghouses as a way to manage their risk. And then they, with them suddenly being out of the system, it created a lot of risk within the system to how to settle out those trades. With the blockchain, those trades would have already been settled, and the ownership would have been transferred, or at least the end user would have known for sure that they had transacted with Lehman. They would have had a complete record of that. The end owners would have been completely known, and frankly, I think that there would have been some benefit, not entirely solving every problem in the world, but some benefit to the blockchain even in that situation as well. As long as you look at it as a way to establish ultimate beneficial ownership and a complete and, as you said, a trusted way to establish the chain of ownership over time.
You are very well placed to comment on that. I think my viewpoint is more about My sort of the way that it needles me a little bit with private blockchain is that there's actually better technologies to achieve the same end without using blockchain. There's a number of competing technologies. So I think the end result, I love that end result, and I think blockchain, private blockchain is sort of, that one will
Yeah, I think
disappear over
it's,
time.
in my opinion, a part of the evolution, right? So
That's-
we've
yeah,
been
that's fair.
definitely using the public blockchain and establishing a private blockchain. And it's very interesting because when you talk to clients, they're not yet ready. It's kind of like I would call it FinCloud, the cloud for financial technologies. A few years ago, Nasdaq actually tried to get into that business, and the institutions just weren't ready. They just couldn't grasp the idea of letting go of their data and having it in some server over there instead of in their own infrastructure. And within 5 short years, they've completely embraced it, right? And I think that's what's going to happen with the blockchain. I think the beginning of it is, I just can't quite let go of that control I have around knowing that I've got a private network of computers that's managing the data around the blockchain and that transfer of ownership, and it's so critical, and what if it gets hacked, and blah, 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 blah. But ultimately, I think that it's just an evolutionary element of embracing the blockchain technologies over time.
Bingo. I think that's very fair.
I'm going to open up. We have about 10 minutes left. I'll open it up for questions. We've got a great panel. If anyone has questions, I think there's a microphone coming your way.
Thanks so much for your thoughts and comments, guys. I was hoping that maybe we could hear a little bit more from Google and what tools we might see from Google in the next couple of years, or 3 to 5 years, for either family offices or sophisticated investors to enable us to improve the analytical process.
Yeah, absolutely. I mean, to a large extent, you can already see that today. Google's motivation in the cloud it sort of goes along 2 dimensions. One is infrastructure as a service. That's just bits and bytes and virtual machines, and it's a well-known facet of the cloud. It's a sort of it's utility computing. That's absolutely great. We do that really well. Google's aim is to put out all of its internal services as services in the cloud. So if you look at or if you read about all of the things that Google's done over the last 15 years, all of those are or have become available. Something like Bigtable. Bigtable is a data store. People put data in there. And it works on an almost interminable scale. And you can go sign up for it today. All of the machine intelligence capabilities. TensorFlow is the library that Google came up with. AlphaGo is built on top of TensorFlow. You can have access to exactly the same thing. Google has a very straightforward aim of democratizing everything it has access to, because it doesn't see any value in keeping that as secret source. Everybody should have access to that, because it's what you build on top of it that really makes a difference.
Another question? There's one over here.
Well, thanks very much for the insightful comments. I have a question relating to, I think people say fintech is a very grown-up business, unlike tech startups in general, because whether you're disrupting banks, insurance industry, or asset management, those are highly regulated industries. I was wondering if you can share some of the insights or success examples of bringing the regulators on board in facilitating that transition. And I think also latch on to the gentleman's question, if you were to make a forecast, what will be the impact to the main street and men on the street in terms of the impact on the asset management industry in general? Thank you.
Sure. Well, I think that there are 2 somewhat separate questions. So I would say that, broadly speaking, the regulators, and of course I have lots of interaction with them, are they're what you might expect them to be. They're very open-minded. They're trying to understand the transitions in the industry and to make good decisions to support the advancement in the deployment of new technologies and approaches, while at the same time trying to ensure that their objectives are met, that the markets remain a level playing field, And I think there's always grumbling, but my own personal view is that the regulators are doing a pretty good job of moving forward with market changes, and that I don't really have any doubts in my mind. There's no reason to believe that they're going to be blocking any of this advancement. They're just working hard to understand and make good decisions. So I have no worries that we will not move forward because of regulation. It may take a little bit longer, but that might be a good thing, because it is important for there to be oversight of something as important as the financial markets. As for what benefits that all of this will bring to, for example, retail investors, I think that the benefits have been very substantial. I think it's widely seen, and this can be debated a little bit, but the new structure of the markets, and I'm sure you'll agree, has lowered the cost of trading for retail investors. Spreads have tightened. From a structural standpoint, the markets are working pretty well. I think that the evolution of products, for example, the ETF industry, has created lower fee vehicles for retail investors, and this is technology-based, to be in the market. I would imagine that the advancement in AI approaches, I hate the name, but robo-advisory services and other more algorithmically driven asset management capabilities will have a very big impact on offering to retail investors products and services that make a lot more sense than perhaps a traditional human-managed fund that isn't really delivering the kind of performance that the fees would justify. So I think that broadly the benefits have already been very substantial, and there's a lot more good stuff to look forward to.
Dan, you want to chime in there on the?
I agree with everything. If you were to chart the cost of beta for the last 20 years, it just looks like this. Okay, that's the benefit, right? Everything we're talking about is a tool or an ingredient in the megatrend that the cost of beta is doing this, right? And it's going to continue doing this until the cost of beta gets to near zero. And that's very scary for people that are trying to charge fees off of beta or off of leverage beta. And that's really great for the mass public.
I see another question.
One more question. It's hard for me to see with the lights in my eyes, but.
Hey there. This is Jackson Mueller, and I'm with the Milken Institute in Washington, D.C. One of the questions that I've kind of come up with is who's at fault if an algorithm goes, for lack of a better word, AWOL? These algorithms, they learn from their experiences. Who's ultimately at fault? Is the programmer behind the algorithm? Is it the firm itself, or do we start suing Skynet?
Well,
the last one.
Yeah, the last one. The regulators.
The key is we're going to start giving them human rights. Watch this. It's not a joke. In 10 to 15 years, we're going to start talking about computers and artificial intelligent entities having certain types of rights, and then once they have rights, they'll be liable.
The regulators are really kind of pouring over this now. MiFID II is clearly into trying to understand that. Reg 18 on the CFTC side. Adena, I'm sure you're getting lots of queries about that. You had to deal with some of the fallout from some of the past experience.
Yeah, you can see where algorithms today, trading algorithms that go rogue, you can see ultimately that it is the broker-dealer that's at fault, and they deal with that through whether it's regulatory fines or, frankly, financial catastrophe for their own firm. So and yes, the broker-dealers today are at fault. Now, once you move that up to the investment management chain, the investment managers do still go through broker-dealers to access the markets. So there's just an interesting chain of liability there that will develop as they understand ultimately how they manage that chain. But right now, a lot of the fault sits with the broker-dealers.
Yeah,
David,
I think it's an interesting question. Maybe frame it in a different market just to make it more stark. So imagine that self-driving cars are released to the general public, or even right now, you can use an autopilot feature in a Tesla. So you get in your Tesla, and you flip on the autopilot, and the thing plows into a crowd of people. Okay, who's at fault? Okay, well, very hard to say. Tesla would argue probably that you misused the technology. The driver of the car would probably say, hey, wait a minute. I thought it could handle these kinds of situations. And so, and then you get this very big debate. I mean, I think to a certain extent, Tesla is very brave that they have introduced this technology so rapidly. I think other auto companies have held back in part because of exactly the point that you're raising, that these issues haven't been fully sorted out. There's 18 seconds on the clock here, so I can't really talk more about it, but I think it's a wonderful question. I would say that our legal system is, in fact, capable of sorting out these issues over time. We've evolved our laws and how we think about the world, over the past couple hundred years considerably. But I would argue that the rate of change of technology has really accelerated recently, as you can see with Tesla's self-driving car. And the legal system and the rate of its ability to adapt to these changes has not accelerated. And so we have a big conflict right now, which is the world's changing very rapidly. Technology makes a lot of things possible that have not been possible before, but the legal system doesn't exactly know how to deal with it, and the legal system moves at a speed that just can't keep up. And so ultimately this could hold back technology.
I think with that, we are out of time. I would love to thank Corrie Elston from Google, Adena Friedman from Nasdaq, Dan Nadler of Kensho, and David Siegel from 2 Sigma, and thank you for joining us.